Hi guys, welcome to the risk sentiment lecture. So hopefully by now you'd have completed the task we have set for you in the fundamental lectures, and at the end of the task you'd have come to correlated markets for your currency, as well as discovering the equities markets in the economy that you are essentially creating the market profile for. So moving on to risk sentiment as a whole, what we mean is every day when you come to the market, there's different risk flows and there's money moving in and out. What I want you to understand from the get-go and always have at the back of your mind is money doesn't just disappear. Money's always in the market looking for value. It's always looking for where it can go to. And when I talk money, I mean people investing in money. Speculators are always looking for where they can get maximum reward for minimal risk. Essentially, that's the objective for any investor. But sometimes they'll be happy taking on more risk when there is higher chance of the reward. So what we tend to see is money flowing in one or the other direction, and with it flowing different equities, currencies, commodities, and government bonds, as they will flow where money flows essentially. So if we just break it down, so we have equities, which are essentially the stock indexes for the given economy, the FTSE 100, the DAX, the S&P 500, Dow Jones Index, and these tend to be risky assets, so they will react to changes in sentiment quite quickly. So let's say we have the dollar is very strong on that day, being there's some good economic data coming for the dollar is very strong. When the dollar is strong, we tend to see equities depreciate in value as money flows into the dollar. It's as simple as that. It's vice versa as well. Let's say, for example, on the S&P 500, let's say Tesla is the 9th biggest company on there by market cap. If Tesla had some really good earnings, as well as Apple, would see the value of the S&P stocks rise. And if they rise high enough, and as they start to rise, the dollar is going to start to depreciate in value. Why is that? Because money is moving in between these two assets. It's moving from a safe haven as the US dollar to a risky asset as the S&P. But because of such strong data coming in, well, such strong earnings reports coming in essentially for Tesla and Apple, as I just mentioned, we will see these rise in these equities, and it's a similar situation across all the equities in the world. So it's definitely something worth knowing, and worth knowing when it actually happens, which I'll talk about how I approach risk sentiment as general when I just start my trading day. So going to currencies, so we look at for safe haven currencies, that being the US dollar, the Swiss franc, and the Japanese yen. The US dollar is the reserve currency of the world, and the chances, and whenever we see high news impact the markets, whatever the currency, as the US dollar is the reserve currency of the world, it will tend to appreciate in value when there's, so for example, as I talked about Corona markets last year, when we see Corona hit, many currencies depreciate in value, and the dollar rose in value. As I said, money just doesn't disappear, it moves across markets. Why does the dollar appreciate in value? Because it's a safe haven currency. The chances of the US government like essentially going out of business are near enough non-existent. That's why people just invest their money into the US dollar during times of uncertainty, and during times when there are bad things happening in the markets, like for example, so US dollar, the Swiss franc is also a safe haven because of its financial stability and economic stability of the country, as well as the Japanese yen. It has always been a safe haven because of its carry trade opportunities. The Japanese yen and the US dollar tend to move in tandem, as well as the Swiss franc. Not always. It's a generalization across the long term. They do tend to move in tandem. So be careful of that when you are trading the dollar against the yen, dollar against the Swiss franc, essentially. And the high beta currency, so these are more volatile currencies: Aussie dollar, New Zealand dollar, and the Canadian dollar. So the Aussie dollar is actually quite closely linked to gold, as well as Australia exports a lot of gold. So when gold prices tend to go up, it takes the value of the Aussie dollar with them, and the Canadian dollar is quite closely linked to US oil, as when the oil prices go up, they tend to bring the value of the Canadian dollar with them. Once again, it's a generalization. I'm not saying they're closely linked all the time. Over a general period of time, intraday as well, if you see big moves into if oil moves hard on the day, for example, and you see this big spike in oil, chances are there will be a spike in the Canadian dollar as well. So just be careful of these relationships. Sorry. Moving on to the commodities market. So sorry. Yeah, and when we see these safe haven currencies rise, these high beta currencies will go down, and vice versa, something I'll talk about in a minute. Moving on to commodities. So individual supply and demand factors should be acknowledged beforehand. For example, as I said, talk about oil, the recent OPEC meetings and general demand for oil. So last year, as you know, when we had the lockdowns, demand for oil fell miserably, where oil just absolutely fell through the roof. But then the Canadian dollar didn't. So that's when you need to know the individual demand for oil, individual supply and demand factors for such things as oil and gold as well. We tend to see gold appreciate majorly before Valentine's Day, before Christmas, like year on year. But then we had gold hit all-time highs last year when people were looking for that safe haven asset, essentially, where they could put their money in during times of big uncertainty. So just be careful of these relationships going forward. And then we have the government bonds. So these are actually considered as one of the safest assets. They can be quite slow moving, as many speculators use them for long-term money flows. Why are government bonds one of the safest assets? We especially look at the US bonds, because, as I said earlier, the US dollar is the reserve currency of the world, and the US economy is the biggest economy of the world. So the chances of the US actually going out of business are non-existent. Well, very, 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 very low chances, near non-existent. So during times of uncertainty, we see these bond prices actually go up, because that's where people are putting their money in. It's safe for them to put money into those assets. Therefore, when we see risk being a major thing in the market, such as when Corona hit last year during financial crisis times, people put their money into the bonds as it's safe for them to do so. So moving on. So when we have risk on approach, and you hear us talk about risk on all the time, that means people are willing to risk more in the markets because the reward might be higher. And you'll see equities will rise. So the S&P will rise, the S&P FTSE, the DAX. You see the safe havens rise. You'll see the safe havens fall because of the money flows moving in between markets, as I just talked about. So the safe havens will fall because the money flows will be going into this higher yielding, rewarding assets, such as the equities markets, as I just talked about. High betas will rise. So your Aussie, your New Zealand dollar, and your Canadian dollar will tend to rise. Commodities will tend to rise as a result as well, and the government bonds will fall. So the government bonds will fall because people are willing to take on that risk. And normally with government bonds, the interest you get on these is very bleak, and people will only go to these government bonds when the markets are really in turmoil and there is big things happening in the world, such as Corona, as I keep going back to. Risk off approach is just the opposite, essentially. So you'll see equities fall, you'll see the safe havens rise, you'll see the high betas fall, and you'll see commodities fall, and the government bonds will rise. So risk off approach is really what March 2020 was about. Equities fell dramatically, S&P fell loads of points. I can't remember off the top of my head, but fell dramatically. The safe havens, the US dollar had a big impact, big rise. High betas fell dramatically. Commodities actually, so as I was talking about, US oil fell dramatically and it went into negative figures. But then the gold fell at the beginning, but because it was seen as a hedge, essentially, people put their money into gold, so gold hit all-time highs last year. And then government bonds did rise for a period in March last year as well. So what I'll show you guys now is just how I look at risk sentiment. So let's say I come into the markets in the morning. What we tend to see is the risk flows coming from the Asian session through to the London session and carry on into the New York session. So when I come in the morning, first thing I look at is always my Nikkei 225 index, as it's the main index in Japan. It's the biggest index in Asia. So I always look at that to see what the risk flow was in the Asian session, and as that's likely to lead into the European session. So then I'll look at the FTSE 100 as well as the DAX. And so I can see maybe I could come in and see 1% increase over the night, and then these are likely to follow that. I'm not saying it happens all the time, but when it does happen, when you see, like, for example, 1 to 1.5%, and then these open at 1.5%, trade around 1.5% throughout the day, chances are the S&P is going to follow on the same risk. So I have my the S&P futures and the actual S&P index on here as well, just to know what the risk flow is like during the day. And then we have the US dollar index as well. So I just tend to flicker through this every day to see where the dollar is going, how strong the dollar is. And sometimes look at the correlation with the S&P. So this orange line here is actually the S&P. You can see how they're just inversely correlated. So in the crash last year in March, because the S&P fell drastically to around 2,300 points, and the US dollar rose from 12,000 index points just below 13,000. So you can really see how money flows differently. As I said, money doesn't leave the market, money flows in between the markets. So that's really the whole point of just understanding this risk sentiment. You don't want to be stood on the opposite side of the market when, let's say, the dollar's very strong on the day and you want to short it. Be wary of the risk sentiment and how the dollar moves on the day, and as how different assets move on the day as well, because you'll see this strong correlation as you hopefully have done in the previous task we've set you. So I'm not going to go into too much detail on that. And the last thing is just the bond markets here. So I've got the bond yields and government bonds. I tend to look at these once a week. Maybe it's not something I look at all the time, but yeah, so this correlation is similar between the bond yields and the S&P. So, but yeah, apart from that, you just want to have a basic understanding of risk sentiment in general and how it's affecting your day to day. But I do advise you have one equity from each trading session, essentially, so you can see how risk may flow in between your currency pairs in a day, how it has the potential to actually affect your trading.